Hello, my name is David O'Kelly and you're very welcome to KPMG's Capital Ideas podcast. This is the podcast where we talk to investors in Irish business. Today I am delighted to be joined by John O'Sullivan from Act Venture Capital. John is a veteran of the venture capital industry. He is a really successful investor. I've known him for about 20 years. I think we're going to have a great conversation. John, you're very welcome to KPMG. To start things off, can you tell me a bit more about Act Venture Capital?
Yeah, so probably best taken on a couple of horizons. So we're a tech-based investor and we have been for 20 plus years. Now the definition of that has changed over time, which is what's made tech investing a bigger industry than it would have been. Maybe we'll talk about that a bit later. Check size is maybe what people really want to see the filter on VCs. So our investment range from us is anywhere from 500k at seed stage, because we're a very active seed investor, up to probably Series B entry points, and that will be up to a 10 million check.
Right.
And the kind of rounds that are done with either lead or co-lead rounds, roughly between 1.5 and 2 million, up to 10 plus.
Yeah.
The rounds would be larger. Our check size could be 10. So you see large syndicated financings of 20 or 30 million as the companies scale, and typically we're writing checks all the way up the level. So we're full stack is the way we describe it. And what do the companies look like? Because that makes it, it's one thing VC speak of for size of check.
Yeah.
So we have teams that we backed with 2 people and an original idea.
Yeah.
As I'd say in the industry, 2 people in PowerPoint and maybe some IP, all the way through to a scaling companies and maybe 300 plus people and 60, 70 million in revenues. And our experience set is in that range. Yeah,
and I think most people would be surprised to see that you've raised, your own fund has raised 600 million over the years.
Yeah.
There's quite a bit of capital to deploy. Do companies usually kind of enter at the 500k level and graduate through, or is it all sorts?
We're quite fortunate that we've been able to see. We use our seed funds ideally for people to graduate through. Yeah. That's risk management from our side, and actually risk management from the company side. Yeah. Because they understand who they're dealing with and what that's going to be like.
Yeah.
So what it does mean is that we have the capacity to deeply follow.
Yeah.
Because we're looking for in our world, seed investing is about understanding, is this an opportunity to put more capital to work? Yeah. Not securing your full position at the outset.
So those Excels that show like 500k once and then off to the stratosphere, that's
no, it generally needs more fuel. It might hopefully it goes to the stratosphere, but it definitely will need the fuel. But our larger sort of Series A, Series B activity, we shop the whole market. So that isn't just the seed investments we've done. Yeah. So if you looked across how we build a portfolio, you'd see a very high level of actual deals at the seed stage. But when you look at the Series A, Series B and expansion activity, that's kind of equally split between companies we've got to know at seed stage and actually just companies in the marketplace generally raising Series A's, B's or C's.
Yeah, yeah.
So it's given us a lot of flexibility. That decision we made was 10 or 12 years ago. We started to run both activities with a very specific purpose from seed to A, B. That's given us a lot of flexibility up and down the stack to meet teams at different stages. Yeah, more than we'd had before.
And when you meet those teams, I know you give this a lot of thought. What type of attributes are you looking for? Like, what's the ideal venture capital investment from your point of view?
There's a lot of debate, and God, there's endless podcasts on this subject, and we spend a lot of time reading about it. And different VCs, I think different investors, even PE, would have different flavors of it. So the standard answer you get, and it's not standard because it's trite, it's because it's true, is we always back the people. But it's set in a context, so maybe what's more helpful is, generally speaking, we back people in a marketplace. So if you don't like the market, it doesn't matter what you think of the people. Yeah. And that's kind of where people are silent on describing it. So generally, a more helpful way to talk about it is VCs are looking at market, people, product, and numbers. Yeah. Now, they sound like distinct things, but they play off each other.
Of course, yeah.
But they generally have to get comfortable on all 3 of the 4 and ideally all 4. So if you take market out of that equation, it's unlikely that any investor will get comfortable with the team. Yeah. Now, post-investment, that changes. So investing money is actually quite easy because you're giving away money in exchange for share certificates. And hopefully it all works out. Yeah. Not to make light of it, but that's you're focused on the future. Yeah. But now that bit has happened and all the intensity has gone, most VC activity, and PE would be the same, is around what happens next silently. That's the bit you don't read about in the newspapers, because that's the kind of the bit, okay, well, how do we convert that to value that we can all, both the founders, management teams and the investor gets? Yeah. And that intensity around people, product, market's numbers is far more interesting than a kind of simplistic analysis at the point of investment, because those things can change.
Yeah.
And they're meant to change.
But how does that typically manifest in the real world? Because the market's the market, and you're not going to come in and start writing code. So presumably the technology may have a development path, but it largely needs to be at least a solution the market wants.
Yeah.
So can you give me maybe examples of where you do lean in, where you spend your time with
so
companies?
Ideally, see, venture has an aspect to it because it's clearly, it's uncertain.
Yeah.
Right? So, why does venture capital exist? Because it's providing capital in a situation where either customers or banks won't provide it.
Yeah.
Because the risks are viewed as too high.
Mm-hmm.
Now, given that kind of no one really knows the future, you have a broad set of assumptions, both the teams and the investors, that you're now going to deploy the human capital and the investment capital to figure out were the assumptions correct.
Yeah.
And it's that level of uncertainty that plays out. So the first thing you're doing is you're generally adding to the team.
Right.
So, the talk about VC engagement, it sounds like a very kind of dry subject. But you've got the money now. So the thing the VC is most obsessed about, and when I say obsessed, if they're really doing their job, they're probably obsessed quietly. They're enabling you as a team to do it.
Yeah.
Is what's the next 10, 20, 30, 40 hires? How good are they?
Yeah. You're a coach, not a player.
How good are they? Do we have a system in place, probably informal system makes it sound very grand, where actually we're targeting the right talent and getting the talent to join? Not straightforward.
No.
And then when you have that talent joining, how do you get it productive in the right way? And at the same time as you're doing that, you're now moving forward with your product, your customer discussions, your kind of milestones. So this orchestration is incredibly difficult for teams to do. You can argue the VC, has seen many patterns of this before, but the VC can't be confused with who's doing it. What they're trying to do is enable it that it's happening in the right way at the right pace.
Yeah.
But the tempo and everything and direction has been set by the teams, unless the investor believes that something fundamentally has changed.
Yeah.
And you made the point, either in the market or around the product, and usually market and product are connected.
Yeah.
Something fundamental has changed, and they begin questioning that in cooperation with the team.
Yeah.
Because where most investments go wrong is they over-index on a certain assumption. They invest against that assumption, and it turns out it's incorrect.
Yeah.
And that's nobody's fault. Everyone does it at the best possible will. But it's the cost of those corrections is generally the difference between good investments and poor investments for the teams and the investors. So there's no difference in what matters, really. There's no magic protection for the investors or for the teams against that kind of decision making.
Yeah. We might get into some of the more difficult situations there. It's not,
but hopefully we won't get into them.
Yeah. But no, I think it's important for people to understand. I know. I think you agree with that sentiment too. That deals have to be set up for success. But before we go there, just in terms of maybe covering off some of the other basics of deals and so on. Previous podcasts we've had private equity on, and typically in a private equity deal, that the founder motivation can be funding the business, but also there's cash out and other attributes to the deal. Is that typically a feature of your deals, or how does that work in a VC environment?
It's probably two headings there. So now, thankfully, the PE market has expanded and the VC market has expanded to such a degree that there's a lot of blurring.
Yeah, there's
which has been generally good for companies. There's no question about it. There's lots of different sources of capital or different flavors of what people invest in. But the historical definition was the VCs are happy to run losses in exchange for growth.
Yeah.
Once you're hitting the right metrics, and the PE guys want some sense of stability in which you can use financial engineering, and maybe some growth and other tools at the large end. Some tuck-in M&A, some synergies with other companies to drive their returns.
Yeah.
Now, if you take those kind of those differences on the VC side, where things really different is that pursuit of growth drives everything.
Yeah.
It doesn't work without the pursuit of growth.
Yeah.
There is no.
Can you expand on what you mean as growth? Like in a normal mature company, like 10-15% growth a year is awesome, but I think you've more in mind than that.
Yeah, no, so it's funny when you're reading the subject, it's kind of like the VCs have moved the cheese in the last year and a half with the kind of retrenchment of the VC market. So now you hear people talking about 200-300% growth, which is kind of amazing.
Yeah, totally.
In the context of the losses that you're running, because that now matters.
Yeah.
But any business that's running, sort of VCs would like to believe they're getting involved in a situation that's running, 75 to 150% growth. Right.
Wow.
Now, the reality is, does every company do that? Well, generally every business plan will show you that.
Of course. Yeah.
And that's okay, because we want to believe that too. Just remember, the VCs are incentivized to want to do this. That's we don't make any money. There's no mystery to this. There's no money made in VC by not investing the money.
Yeah. Yeah.
Right? So, well, it's frustrating for teams, but equally it's important to understand, well, hang on, the way you set up the investment and the way you begin working together, does it allow for slightly lower levels of performance and still get to success? In some cases, that's the right attitude. In other cases, you have to push, because of the market point you made earlier on, you have to push for these super high growth rates, because that's what's expected in the context of that market at that time.
Yeah.
And then everyone's got to be aware of the risks they're taking as they run to that headline. And this is where the over-indexing begins. So if you, a simple example, but it's a regular one, a team and an investor genuinely believe that their product is right for prime time. They've had enough testing, they've had enough early customers, they've had enough feedback, all very rational. And then they hit the button to supersize the sales team.
Yeah.
Again, very rational. So, and then that misfires.
Yeah.
How long do you hang on to the sales team at that scale before you understand what's causing it not to work the way you thought?
Turns out the first superstar was a superstar in one field, but maybe not yours.
So you get into all this kind of collective kind of understanding of, okay, you touched on earlier on where it doesn't work, but that's a classic case of everyone scales on a certain assumption. The assumption may still be valid, but it's not happening at the rate everyone expected.
Yeah.
So there's a very nuanced discussion as to, well, let's make up some numbers. You've hired 20 salespeople, just for the argument.
Yeah.
Well, do you hold at 20 for a year and a half? Do they get more experience in the marketplace? Do you retrench? Is it a different 20 that you might need? Do you need to change marketing to tune in? Or are you seeing actually a product problem that you hadn't anticipated because the sales force is meeting the market in the right place, is meeting it at the right way, but actually this new bunch of customers aren't prepared to take the product in the current set. Now, untangling that, you can argue, is probably where a lot of deals are won and lost, because it's directly attributable to the capital needed to scale the business. And ultimately, if you get it right, it drives the economics.
Yeah, yeah.
But that first step is always incredibly difficult as you move away from the original founding team.
And I'm struck by organizations growing that rate and the level of change within the organization. How do you coach the management team around that, the founders, in terms of dealing with that fundamental change to the shape of their business?
Ideally, in the pre-investment piece, and as deal cycles have speeded up, some of this has got a little bit lost. Now, it's important that deal cycles speed up. It's good for founders, good for entrepreneurs.
Yeah.
So I'm not saying that they shouldn't go faster, but something gets sacrificed, and some of what gets sacrificed is as a kind of building a mutual understanding of what we're going to do together the minute we have the money. So if you take that out of the equation, you just have a very fast deal cycle. Well, actually, you're now going to be talking about what scale up looks like after you have the money. You've had no preceding conversations.
Yeah.
To understand your relative view of risk, what all this means. Now, that conversation, that dialogue. So, coaching a team is a strong word. You have to remember, you've kind of backed them to scale it up.
Yeah.
Probably the most meaningful intervention is the extent to which you say, listen, you've got the money. We're past that phase. Before we hit the buttons on scaling up, never mind what it was in the PowerPoint in the plan, let's just recheck the assumptions.
Yeah.
In a balanced way. Because there's a tendency for the VC as well and the founders to go, we've got the money, we wrote the plan 6 months ago or 4 months ago, and now that we have money, we're just going to push. And I think it's important for the investors to create a little bit of room to say, well, if it needs to change for rational reasons that we can all discuss, let's have that conversation today. And that's okay.
Yeah.
No one's going to get out the warranties. No one's going to say the plan has changed. This is shocking. No. People want to understand: is it still valid? Because there's a very difficult phase for teams to say, well, at what point do we say to the VC who's write the check that we have different ideas now, or things have changed? It's immensely difficult.
When you come back with all those sales data saying nobody wants to buy the product as it is.
So the VC is kind of, ideally, has got to, without even making it explicit, is kind of make sure there's enough room for those conversations, because misconfiguring or misfiring on the resources or the plan is in no one's interest. The whole idea that the VC is protected from that or the team it's fake. It doesn't exist. Yeah. But it is the VC's job to create the room to say it's okay, that we need to reassess and recheck what our assumptions were.
And are there, I know every deal is obviously going to be different, but the areas that the teams expand in, are there typical resources that come in, typical types of people that come into the business at that stage after seed or Series A?
I'm always very low about the generalizations about this, right? Because if I go back to those maybe simplistic buckets for the sake of the discussion on the people, the market, the product, the finances, companies have different mixes of needs at different points in time. These things are always changing. In very large companies, they're changing all the time. You just don't see it. They're so mature. There's no need to think about it. It just works. But organizations that are very small and trying to get big, that challenge changes day to day. So the first step could be, well, actually, the classic one that's given, and I'll give a simple example, is we need to hire a head of sales. Let's make it a bit more complex. Well, actually, we need to hire a CTO. This isn't to say that our founder's technology is incorrect. We're at a stage now where we need to formalize a lot of things that we didn't do before. So there's the human aspect of that. Well, how's that going to work? How do we handle that? Because it's a change of how things are going to work. And sales is always seen as something over there. It's quite funny. But when you get into the kind of nature, and it's tough for the VCs, because generally when we're investing, we're kind of investing in this kind of fuzzy mix of talent that a team would have with deep market knowledge combined with deep technology knowledge. And it might be embodied in one person. It may or may not be the CTO, may or may not be the CEO, but they have that depth. There's something about the synthesis of those two things that makes this team special in this marketplace. The way we say in the office, they have it under their fingernails. They just do. Injecting other humans into that to keep the richness of that understanding, but also to make sure that the team give these people enough room to get embedded and become trusted, is, you can't say there's a process for that, but certainly most experienced VCs are very aware that there's a big tension point coming up as you bring in that type of talent. We're changing leagues. We might need to bring up to the Premiership. And that has implications for everyone around the table, hopefully positive. But if that early phase doesn't go well at a sort of people level, all the feedback you're getting after that about what's working or not working is now clouded. So that maybe nicely kind of goes on to, if you talk to founders about their fears, and one of their fears is always that, I heard a fella who took on venture capital, and sure, 6, 9, 12 months later, the CEO was out of a job and all the rest of it. Those situations can arise, but tell me about the types of protections that you need and dealing with those types of situations where, it maybe isn't working as people had hoped. Well, I guess the first point to make is, when VCs invest, I think private equity is a little bit different, because hopefully the businesses are a little bit more stable. And rightly or wrongly, they'll think they have a little bit more flex in people and change. Because the business is more stable. In the VC's context, the point at which the check is written and the commitment is made, most VCs that I know move into a mode of, okay, this is the team I'm backing for today. Other people are going to be joining. But actually my job is to make sure that this team can go as far as they can possibly go. And ideally, that's the whole way. So this change agenda isn't on the table at the get-go. It isn't. Now in PE, it's a lot more front and center. That I won't go through the details, but it's a bit more evident in the playbook. What's my succession for my exit in 5 years' time? I think it's very much on the table. And they will operate against that level. The VCs will try to more get the best out of people, and ideally, these people are expert. That's why you're investing in them. So the whole idea that you can change them quite rapidly is quite alien initially. Now to get back to your question, if down the line things aren't working, that just doesn't arise overnight. That isn't a kind of magic moment. Things will have been happening over time. Ideally, if the investor is doing their job, that's a conclusion a group of people have reached at a certain point.
Yeah. Yeah.
Now, it isn't always that lucky that that's the way it happens. But thinking about it, if something isn't working in the business, it's becoming evident over time. And it's important that the atmosphere is created where that discussion is probably as balanced as it can be, as people try to figure out, well, is it the market that something's happening? Is it the product? Is it something to do with the way we've set up and configured the organization? Or is it something to do with the people we've onboarded or the existing people? Now, they're fine to discuss in this context. They sound all distinct, but they're actually pretty fuzzy.
Yeah. Separating the personal executive conversation from the shareholder conversation is not easy.
For example, so the senior executives are the people who are interpreting the market.
Yeah.
Right. So you're going to go backwards and forwards around this a little bit. Now, if it's blatantly not working, there's two forms of it, and the change is needed, usually because the plan isn't working and more money is required. And the people with the money feel, well, something else needs to happen here. So there usually is a context. Now, is there, let's call it mad behavior? There is, but it's very rare, actually.
Yeah.
Generally, there's a context for the plan not working, or there's a breakdown in personal relationships.
Yeah.
Or there's both, which is immensely difficult for both parties, actually. Because from a VC perspective, it really limits our scalability if we've got to get into that kind of level of team change.
Yeah.
When you really get into, so we run a reasonably sized portfolio, you want to add to teams and enhance them, and let the founders, take them the whole way if you can, and it's part of our job. But you start adding up a lot of team change in the middle of all this, and team change is uncertain.
When we were talking beforehand, getting organised, you were telling me about your ideal transaction.
Oh yeah. Oh, David, I thought you wouldn't. You promised me you wouldn't ask it. I'm going to have to edit this out.
This is a very open conversation. It's only you and me.
Yeah. So, what are, to be fair to your original question, what are founders really worried about?
Yeah.
And correctly, they're worried about probably the following. At 3:00 in the morning, what are they really worried about? Well, is there, the scenario where I end up out of my company and I own no shares?
Yeah. Somebody takes it off.
Completely reasonable.
Yeah.
Now, I'd be worried about that. Anybody who owns shares in a company at a significant way, and doesn't think about this, is kind of being a bit reckless.
Yeah.
But as a good lawyer will tell you in no time, the levels of protection against that are quite extraordinary. Whether they're in the agreements or they're in case law and the way company law works, that's quite extreme. But that doesn't take away from the fact that people think something's going to change here now. It's been a conversation on these 3 or 4 individuals, and now we're going to inject 10 million or 5 million or 20 million and these 2 or 3 individuals. Yeah. So something is going to change.
Yeah.
So that it does bring out that rechecking of, well, what really happened here. And at the same time, the founders correctly and the management teams believe, and the evidence would suggest when they're running their own situation, is that actually we've got this done. We know what we're doing. We've worked it out. We just need the 20 million or the 10 million to achieve this plan, and we're done.
Yeah.
And it'd be very nice to have lots of inputs with the VCs, but not really.
Yeah.
Because correctly, their feedback to themselves is, we do know what we're doing. And when they get the money, that's validation that you do know what you're doing.
It's usually pretty good, yeah.
Yeah, because someone put 20 million in your bank account and said, I believe you.
Yeah.
That is what's going on here, right? So it gets a bit tricky after that, because ideally, what I like and what they like are completely the same thing. To never see each other again until it all works out.
Yeah.
Just, it's really simple. They'd like the odd board meeting, but really, can we keep it a little bit casual?
Yeah.
We don't want too much interference or too much overlay, because we've got this. And ideally, as a VC, I prefer never to meet them again, and I'd love them to ring me up and say, great news, it's all worked out perfectly.
Yeah, we've sold or IPO'd or whatever.
Send us your bank account details, because we're going to send you 7x the money.
Yeah.
Now, both of those are exactly the same scenario. The extent to which they're unlikely to happen will drive the level of interaction.
Yeah. We'll keep looking for that deal.
Keep looking for that deal. And to some extent, and there is a corollary, and it's going to sound a bit funny, the companies that go better, there's a corollary, their board packs tend to be smaller.
Yeah, that's interesting.
If you ask any VC what's correlated in board pack size and progress of business, they're inversely correlated.
Because people know what to look at.
Yeah.
Understand their business.
They understand their business. They know what matters. They can, and it's a very difficult thing to do. They can abstract large amounts of data into what matters and when, because you've heard that terrible phrase, "I want to know everything." Yeah, nonsense.
No, you
don't really.
No, you don't.
Yeah. So that abstraction is an incredible skill.
Yeah.
But if you ask VCs who have run reasonably large portfolios over time, that question and they printed them all off, we're convinced it's correlated.
I may continue to ask that question.
Weigh them.
It's an interesting observation. And the other piece that people get anxious about and so on, particularly around term sheet stage, is venture capital investing often has some form of liquidation preference and so on. Yeah. Can you talk me through that structure and the thought process?
So you've seen, and maybe just to give the audience, the audience here will be pretty sophisticated, but just in case, see, the liquidation preference, and there's multiple forms of it and variants, but at its simplest is probably 3 forms. The first is there's no preference.
Yeah, everyone's ordinary
shares. Everyone gets their percentage of the outcome as per the cap table.
Yeah.
The next version you see of it, and the mathematical experts can create lots more versions, but simplistically, is the investors are entitled to their money back or their percentage ownership.
Yeah. The higher offers.
So they can argue the two. And the final variant is the investor can be entitled to their money back plus their pro rata. So where people start getting a bit more emotional. Now, the history to these things is a little bit funny. So if I go to the extreme one, which is what founders are most concerned about, generally when you see that structure, there's been an argument about price that couldn't be resolved.
Yeah.
Okay. Because really what you're doing is the cap table is a vision of what how the future will be shared. Yeah. And you couldn't quite agree that today. And the team want this price, but the VC wants another price.
Hard.
And actually the preference is used to resolve that.
Could I suggest somebody maybe wanted to put a term sheet out that flattered?
Sometimes that can be the case, but generally now there's such good advising going on, people do the spreadsheets.
Yeah.
Right? Yeah. So that is kind of, in a nutshell, where that debate comes from, is the VCs looking for protection, because if they've overpaid and the team go for an early exit, it is a substantial impact on the VC returns. Yeah. And remember, the VCs are running a business too.
Yeah.
Right. Yeah. It seems to get lost in all of this. So when you see these preference structures, it's a function of people not being able to essentially agree how the future will be shared. And the VC wants protection that if they've got that completely wrong, they will still make reasonable venture returns. And this maybe is the nub of the argument. Is what's those base cases look like? The either or is a function of actually responsibility for the capital that the VCs have, because we get the money from someone. That is someone's money.
Yep.
And a significant strip of it, a couple of percent of it, in many cases, it's a growing percentage, is actually from the VC team. So it's our money.
Yeah.
Okay. Yeah. And there's nothing more that focuses you more on the fact that not just our money, but we take responsibility from people for people's money, and we kind of know how they earned it. Yeah. So the money's real.
Yeah. And you got to go tell them every quarter.
Yeah, but the money, if I put 50s on the table, the money is real.
Yeah.
The share certs are real, but they may or may not have value in the future.
Yeah.
But we definitely know the 50 quids were real.
Yeah.
And actually, if I ask any entrepreneur in a discussion, well, what would you want if you put 5 million on the table? Because getting our money back is us losing money. So VCs are, and all investors are very committed actually to their customers. And that's where that comes from. So we're providing the capital for the entrepreneurs to have big upside, hopefully. That's the whole idea.
Yeah.
But in exchange for that, we want to be quite cautious of the risk we're taking where we will lose all the money.
Yeah.
Now, the structures are set so we, to protect against that. We don't take out security. There is no security other than the business and the shares. So it's not like we're, taking real security in banking terms.
Yeah.
And it doesn't take beyond that. But this commitment to where we got the money and doing as much as we can to not lose that capital drives some of that discussion. And on ordinary basis, which is nearly ideal for everyone, if it can be done, but normally the pricing discussion interferes with that in the marketplace, actually has an amazing galvanizing effect in everyone being focused on the same objective.
Yeah, right. I think there's a lot for equality and for everyone being
so there is this kind of trade-off that more mature teams make between maximizing deal structure and optimizing deal structure. And a lot of that on their side of the table is about control of the situation. So for example, if you raise money at 200 million, which can sound fantastic, it's all relative, but actually you get an offer at 150, it's kind of hard to take that offer.
Yeah. Yeah, totally.
If you want to.
Yeah.
But if you've taken the money at 75, 80 million, you have a lot more control over that discussion. Or you've taken the money and there's a preference in that structure. So actually the VC could make money if you decide to exit a little bit less. So there's an underlying control element here for teams as well to think about in terms of their ability to have the ultimate control is when we go to exit.
Looking through a table of exit scenarios is usually a very educational process. Yeah. Just in terms of the likely, what are you going to aim for, what does it mean in every different scenario? It's
and there can be an element of teams, thinking, well, if the VCs are adults, it's a contact sport in some respects. If the VCs have mispriced it, so what? To be fair, I can understand that completely. But that can be a boomerang that can come back around, unfortunately, if it's completely mispriced and a team wants strategic flexibility to go and do something else. Now, how do you deal with it?
Yeah. And tell me, that touches on exit, and you often hear, so for people in the community, they may be aware of businesses, but you'll see a headline that a business that the community wouldn't really know about, the wider business community wouldn't really know about having fabulous exits. How do your exits come about? Are they who are they typically to, and how do they come about?
So when people read about exits, it's normally pretty
it sounds great.
Written.
Yeah.
As I used to say, it's like reading old comic books. Sounds very old-fashioned. And with the leap, we were free.
Yeah.
That finally, you turn over the copy page, line. Oh my God, it all worked out.
Yeah.
Brilliant. The reality is, and they're heavily advised, investment banks, and the process itself is intriguing, and they're very attractive things to talk about. But when you filter it all through, most companies end up being bought by companies they know already.
Yeah.
The process puts discipline around everyone in the room, understanding that they're going to have to bid and pay a fair price, and that it's going to be competitive. But it's very rare, and I mean extraordinarily rare, that preceding relationship hasn't been built over time.
Yeah, somebody in the industry once said to me that a lot of these companies are bought rather than sold.
Yeah. Now, what's interesting about it, if you trace it back, and it's a very hard thing, this goes back to that sort of starting piece where investors and founders are getting to know each other post deal, and how just working together on a day-to-day basis, and it's nearly hard to make this instructional, but it's having watched it many times now. There are teams who, formally or informally, and this goes back to market knowledge, deep market knowledge. I think personally this is what it really goes back to. They naturally are able to gravitate towards and find the right people to be touching off strategically for years.
Yeah.
And I always think that that's deeply connected to true deep market knowledge. And despite the size difference between them and the ultimate acquirers, because you want big acquirers, they are accepted into that discussion because of their credibility.
I think that's right. Is that it can, and it may actually play the other way, that the larger corporates or buyers are attracted to those who are clearly leaders in their space
for the same reason.
Yeah.
And there's a bit of magic in that.
Yeah.
And I've seen situations where you've had excellent teams, really world-class teams, but for whatever reason they don't fall into that groove. Right, they haven't been socialized well enough. They're viewed as experts in their marketplace, and they come to the M&A window, and it turns out you can't do a crash course in that.
Yeah.
And they have good exits, but you're always left with that question, and it's a shared question. I mean, I'm not hidden in the having the question myself. We have discussed it. How do we solve for that? Because should we wait longer to allow the CEO build those relationships? But actually, it's a very difficult thing, and then you can see real big differences in valuation.
Yeah.
That nearly seem, unimaginable. Some of the deltas are so big.
Yeah.
And it's the difference between an industry deciding that's the one or that's another.
Yeah. Good player versus great player. Yeah. And good players are good too.
And so what we want to find out is good players who can become great players.
Yeah.
But that behavior you see, and some people that's just the way they operate. Other people, it's like a little bit of a light bulb moment. And a decent VC who's seen the pattern will very quietly say to CEO, is there any way you can just reserve 10 or 20% of your time? I know it sounds vague and weak and mad, just start doing this.
Yeah. Yeah, it'll add a lot to value.
But
Find
it's very
somebody else
hard
to
to
do
say
the 10 or 20% of
it's
stuff,
very hard to say when that value will come up.
Yeah.
But that is where, assuming you're building substance in the business, plus the feedback loop is incredible when you want to do strategy. Because you're at the heart, in theory, you're meeting the other thinkers like yourself.
Yeah, you're a partner, not a supplier.
Yeah. And now your feedback as to what you're going to do next is even better informed. And it's that loop is ideally is what the VC is investing in. If you take the market, it's people who can do that.
Yeah.
And there's a bit of magic in that that's amazing when it works.
It's a bit of magic, but also a bit of development. There's a lot of
some great teams, you just say it to them once.
Yeah.
And they go, oh, yeah, that sounds pretty sensible.
Yeah.
But the difference is it's quite different from customer meetings.
Mm.
And this is one of the challenges of it, is that it's not the same as sales. That kind of interaction can actually feel quite uncomfortable for some people. Other people, it's their natural home. But it's not the same as selling to customers.
Yeah, yeah.
And that can be a hard thing initially for a team to go, what are we going to say at these meetings? What does that feel like? But that's okay. There's plenty of time to figure that out.
Yeah.
Provided you start early enough at it.
Yeah. No, that is interesting. We're coming up close to time, John. Really, one of the things I always like to try and get from a learning point of view is that for founders or shareholders who might be listening here, what are the common pitfalls? Like what when somebody knocks on the door of ACT or somebody else, what are the areas that really the most common areas that they could have brushed up on more beforehand?
Well, one is a refrain I've been at, but I'll come back. I'll repeat it because it's their market story, and I don't mean storytelling for the sake of it. I mean the real story. Actually, that doesn't work.
Yeah.
Now, there's always an open question: is that because it's not a market for VC? It's not a market for that particular VC. That's no one's fault, because VC is only meant to invest in 1 or 2% of all companies anyway. So it can be a bit, it's a bit over exaggerated. It's important, but that market story is the first thing, and that's kind of been a perennial, not issue. And it's a little unfair because there's some teams are really good at telling stories versus their substance.
Yeah.
So it's a very unfair thing. It's very judgmental. So better VC teams need to sort of stand back from that a little bit. The difficulty is why we can't abstract for it totally is that ability, and go back to where we were a second ago, that ability is very much linked to market knowledge, it's very much linked to strategic interaction, and back we are to the exits again.
Yeah.
So in those engagements, the VC and his team and their teammates are trying to poll for that in the market story.
Yeah.
So the richness of that, and I don't mean 20 slides, just the richness and characterization of that. Then you get into all the performance within that context and where they are in the revolution. If I move to the other extreme, which I think is a reflection of maybe the last 4 or 5 year period we were in, some of the heat's come out of it now, maybe a bit more to come, is we did go through a phase where people were light on the numbers.
Yeah.
And I don't mean light on the numbers in terms of the performance of the businesses. They were just light on the numbers in the whole story. Yeah. Now, to be fair, that's entrepreneurs' reaction to the fact that the market, well, what you read on the internet, if we call that the market, is it's all about the story, it's all about the story. No, it's got to be the story and the numbers. And the VCs are comfortable with the losses, but they've got to show where the story and the numbers are going to get matched.
Yeah. And
I think we kind of got out of sync a little bit between the two, because at exit, generally speaking, they'll be very focused on the numbers.
Yeah.
And if we thought we could get a hall pass at exit on really understanding the underlying metrics that matter, and I don't just mean the financial metrics, I mean the precluding the metrics that tell you about future growth.
Yeah.
We'd love that. That'd be great. We would all of that.
Nice and easy.
That'd be nice and easy, wouldn't it?
Yeah.
But actually, if you look at exits over the last 10 or 20 years, which we've been fortunate to look at, that discipline hasn't gone away on the acquirers.
Yeah.
You hear the odd outlier story where they had to have the company and they paid whatever. Great. Normally behind that there's another story. Yeah. There's something of importance, usually in the intellectual property side, or a missing step on a roadmap that they had to have because their own roadmap stopped. So their imperative is huge. But the acquirer's discipline around understanding how the numbers work and will work for them, that hasn't gone away.
Yeah. No, it hasn't.
That hasn't gone away.
No, it hasn't.
But teams again that can combine the two, now they have a huge advantage, not just in getting the VC money. It's about the exit.
Yeah.
It's about that thinking is embedded naturally within them for long periods of time. You don't just build a business and then get to do the exit. It's in the nature of them. And on the exit side, something we talked maybe a little bit before this, the teams get to decide the exit windows.
Yeah.
There is a bit of a misnomer maybe we're talking about that somehow, the VCs are deciding to sell the company. Not so sure.
Yeah.
Ideally, there's a share. Ideally, if you've optimized the deal structure, and the right atmosphere has been around the board table and around the people, there is a shared vision of what a good exit looks like. And everything allows for people to kind of arrive at a common number.
Yeah.
And that informs people's actions collectively over a 2 or 3 or 4 or 5 year period. That's the kind of that's what everyone should be striving for. It makes life easier.
Yeah.
And that's probably an obvious statement. But that kind of singularity of vision, that when something does happen, it's very easy for a group to react, whether they're an investor, whether they're an employee, whether they're a senior hire, or whether they're a founder, to kind of be on a common page going, that's good. We have a common definition of good.
Yeah. No, look, I totally agree that it's very hard to force a management team into an optimal exit. Because ultimately, same as you're backing people on the way in, the buyer's backing people and wants alignment and wants everyone to execute upon the next plan.
Yeah, and you can kind of tell that in the kind of situations where you're looking at an exit, and this isn't a function where the exit's a big exit or a small exit, whatever that means. Someone has the right to pay cash for the business.
Yeah.
If I look back on the majority of those situations, those discussions within the companies and within the group around the board table were incredibly efficient. Yeah. Because that common ground had been built over time as to what good felt like.
Yeah.
And it gave those organizations in that setting a big strategic advantage in responding quickly when the moment arrived.
Yeah.
Which I think is a big advantage, because it's amazing how buyers change over time. You change a senior management team and a buyer, it's very unlikely they'll have the same list of possible targets. Yeah. You think they would if they're a large, they've been thinking about it strategically.
And is it mostly trade rather than private equity?
Yeah, the Irish history is mostly trade. Now, there's two aspects to that. It's trade US in many respects on the tech side, maybe quite simplistically. And exit is a kind of pejorative term as well. People get quite animated about it. In many cases, it's people adding a business division. They're using it to then build.
Yeah, which is fantastic. Ireland story.
So we were very fortunate. If you look at the original team that became Workday here, is a very good example. That was an acquisition of an Irish company of Cape Clear.
Yeah. Oh yeah.
If you go back in time.
Yeah.
So this, they generally want to see a level of maturity that actually we're going to build a business unit out of this.
Yeah.
And that's where you see the synergies between our FDI environment and kind of our tech SME startup environment. And that actually happens reasonably regularly. One of the challenges of why aren't more companies going public, Irish companies going public, which is the eternal question we have too, is well, actually it's a function of the market sizes that they're tackling.
Yeah.
But what we can say, and again we've got to be very careful about generalizing, is we do see a greater ambition among the teams. I'd say, well, I would always say that, wouldn't I? But actually we're seeing it executed. So we've been very fortunate in the last couple of years to have teams that have kind of reset the bar for what's possible for Irish technology companies. So you've the most recent one being Cubic, which is an outcome, and a lot more to come.
Yeah,
it's close enough to $1 billion valuation. The Echo team, 400 million plus, and more to come, I hope, as they build out that business. Before that it was Silver Cloud at 250, and then it was Decawave at 400.
Yeah.
It wasn't so easy as VCs here 10 or 15 years ago, or entrepreneurs, to be able to quickly make a list, and I could name others in other portfolios.
Yeah.
And talk about exits of hundreds of millions and beginning to touch on much bigger numbers.
Yeah.
And that's been a big change. So public companies are kind of out there, and I mean truly sustainable public companies.
Yeah.
Maybe not achievable yet. We will see. I think one or two of those could do it. But the idea that we can move the kind of watermark and people can see it around them.
Yeah, and I think the market has changed a little bit as well. That there is now private equity who will write a check for 100 million, for 300 million, and more, way more.
Yeah, and the Echo situation is a very good example of that.
Yeah, which we're maybe an eventual IPO at some stage. But there's a long way to travel in private.
And that's a very good example of getting to one water point, which is kind of an exit. But the truth is, the implication of how that deal was done and structured, and the nature of that investor, the private equity investor, is they're driving to $1 billion.
Of course they are, yeah.
They may fail, I don't think they will, but they're driving to $1 billion. Yeah. So you're going to see, and we had the privilege of seeing the Echo team from startup, you're going to see another team in Ireland drive to $1 billion.
Yeah.
Now, could we say that easily 10 years ago regularly? And I could pick 3 or 4 other teams.
I know.
Probably not.
No, the environment's very positive. It is very, very positive.
Despite the ups and downs of the funding market,
yeah,
the fact that you can see teams, and everyone's only one phone call away from them if you want to talk to them.
Yeah.
They're actually executing it now. So exits aren't 50 or 100 million.
Yeah.
That still has to be done.
Yeah.
And it's a lot of money. But the fact that the bigger thing is out there for the right teams in the right marketplaces and is fundable out of Ireland, that's a big change.
Yeah, it's very positive. Very, very positive. John, I think we may have to do a sequel. I think we could talk all day. So, John O'Sullivan, partner in Act Venture Capital. You've been an absolute great guest, really, really informative, and thank you very much.
Thanks, David. Really enjoyed it.